What is a 3-2-1 buy down on a mortgage? This is a very common question in today's market, and I'm going to explain it to you in very simple terms. All right? A 3-2-1 buy down is a temporary buy down on a mortgage. What does temporary mean? So you'll lock in your 30-year fixed rate. And let's just say for simple terms, that's 6% today. So say you locked in a 6% 30-year fixed and you purchased a 3-2-1 buy down. So that means your interest rate is going to be 3% lower the first year. So you're going to have a 3% rate in year one. You're going to have a 2% rate reduction in year two. So you're going to have a 4% rate in year two, a 1% rate reduction in year three. So the rate's going to be 5. And then in years 4 through 30, it's going to be at 6%. So you truly have a 6% mortgage with a temporary buy down attached to it. So why are people doing this? Well, they could be chasing the rates of 2021, trying to get that COVID area rate, and that's great, but it's not there forever. It's a temporary thing. But it also could be that their job situation is going to change significantly over the coming years, or just going into a home, they don't know what all the expenses are and they want to ease into that new home purchase and not jump right to that 6% rate. So it gives people options when they're buying. And there's different buy downs out there. There's the 3-2-1, you have a 2-1 buy down, a 1-1, a 1-0. So there's lots of different options out there. Each one comes with its own cost. The most important thing is doing one of these doesn't make any sense unless the seller is going to pay for it, because all they're doing is subsidizing your monthly payment. So you don't want to buy your own. You'd rather have that money in your own savings account making money, and then you can subsidize your own payment with it. But if the seller, the builder, or someone's offering that to you and you're not going to get that money without, taking that option, then absolutely 100% take it. But never fund it yourself. It just doesn't make any sense. But the most important thing about a buy down scenario is making sure that you can afford that mortgage at 6% with your property taxes and insurance. Like, you have to be able to be good with that payment going forward, because if you don't get that opportunity to refinance that in 4, 5, 6, 7 years, that is your mortgage payment. And there's nothing that can be changed about it at that point if the interest rates aren't ripe for a refinance for you. So while that sounds great at 3%, and it is, make sure that you qualify at that 6% rate, that 4 through 30 year term, so that you don't get stuck in a bind. So I hope that explained it very simply. I would love to answer your questions anytime. Please reach out and please follow along and subscribe. Talk to you soon.